Welcome back to Miller Momentum. Today we're diving deep into a powerful, ancient, yet often misunderstood corner of the investment world: managed futures, also sometimes called a commodity trading advisor. It's arguably an older form of investment than the stock market itself, going back to ancient days when merchants would buy and sell agreements to exchange goods ahead of time at a specific price in a regional currency to avoid volatility between those different currencies. Merchants do the same thing today, but with a little bit more complexity. So, if you're looking to build a portfolio that can weather any storm and stand the test of time, this is a strategy you should probably understand. Before we get started though, I am not yet a financial advisor, and what I've got to say is for educational and hopefully some entertainment purposes only. Do your own research and make your own decisions after consulting with professionals and people you trust. Be smart about this, please. So let's get started. First things first, what exactly are managed futures? You'll often hear them called CTAs, which again stands for Commodity Trading Advisors. You can think of them as strategies designed to zig when the stock market zags. But really, they're built to provide returns that are correlated based on exchanges of physical assets, traditionally, like gold and wheat and other grains. But the remarkable thing about this is that in the modern era, they provide returns that are uncorrelated to traditional stocks and bonds. Because with CTAs, you have the flexibility to go either long or short across a wide range of asset classes. This makes them incredibly powerful diversifiers, especially during times of stock market stress when everything else seems to be falling apart together. Traditionally, strategies that used managed futures were a bit hard to access. You had to be, for example, an accredited investor or have a high net worth to get in. Now, fortunately, you don't need a hedge fund to access these strategies anymore. There are several great ETFs on the market. Today, we're going to compare the three most popular options that come up a lot these days. And those are DBMF, KMLM, and the appropriately named CTA. So let's break them down. First up is DBMF. Its strategy is fascinating. It doesn't try to beat the hedge funds, it tries to copy them. And this rhymes a lot with Jack Bogle's approach to the stock market itself. So DBMF uses a proprietary model to analyze the recent returns of the largest CTA hedge funds and then replicates their collective positioning using the most liquid futures contracts for stuff like, oil, wheat, sugar, cocoa, all that kind of stuff. It offers broad diversification across four key asset classes: equities, fixed income, currencies, and commodities. The expense ratio comes in at 0.85%. And you may have caught it that it trades stocks like commodities. This is a very recent development in CTA strategies, and by recent I mean, past few decades. So there's some history here, but again, CTAs are pretty ancient in their pedigree. And it's one of the issues that I'll talk about later that I actually don't like about DBMF, that it does trade stocks like commodities. But because it does so, it can flip from a long to a short position when the stock market is crashing, which further helps with cushioning downturns and actually profiting from market crashes. And that's why DBMF and strategies like it, and the index rather that DBMF is based on, performed very well during the great financial crisis in the lost decade, because it went short on stocks and also took advantage of the plummeting US dollar and also took advantage of certain trends and different trade routes going on. So Really cool stuff. Not for me, and I'll explain why, but you should know about it. So why isn't DBMF for me? Well, let's look at a backtest. So DBMF is basically the average of different returns and strategies across the top 20 largest CTAs. But the principles and approaches used by CTAs are pretty well known. There's only so many ways that you can do a reversion to the mean model, for instance, or do trend following using different signals, which are mostly understood and accepted in the CTA world. So what you'll see is that the top 20 largest CTAs really congregate around a strategy that resembles just KMLM plus some S&P 500. So what a lot of these CTAs will do is they turn down the volatility just a little bit on the general strategic approach of KMLM, say leverage it down to 0.75 of what it usually is, and then add in a fifth of their allocation to the S&P 500, either going long or short. But actually just going long pretty much replicates the performance of DBMF. So I've got it back tested over the past 25 years. As you can see, it's really the same in terms of its trends when you really zoom out. So my argument is, why would I go with DBMF if I could just go with KMLM and add in a little bit extra equities? So I don't personally see a very big use case for DBMF within my Miller Momentum strategy because I already have equities elsewhere, and I don't need it in my managed futures. But I can see someone arguing, well, I want to go with DBMF because it's more of an index-based approach, and if things change in the future and CTAs cut out the S&P 500 from their allocations or put more of it in, I want to follow that trend. And fair enough. Next, we have KMLM. This is a rules-based fund that tracks a specific index. It uses a trend-following algorithm that weighs its allocations based on historical volatility for each asset class. What's notable here is its exposure. So KMLM focuses on commodities, currencies, and global fixed income, but it explicitly excludes equity futures. So it stays true to a more traditional CTA strategy. That means it has no direct stock market beta, no correlation with the stock market, at least directly whatsoever, which is a key differentiator from DBMF. Its expense ratio is slightly higher at 0.90%. And finally, we have the CTA ETF from Simplify. And this is my personal favorite because it is a throwback. It goes pretty much all the way back to the ancient roots of what a commodity trading advisor used to do, and did pretty much solidly when the modern funds, the modern form of this strategy, really took off during the 1970s. So the CTA ETF is a systematic, active strategy developed by the experts at Altis Partners, who have a really good track record with their strategies. Some years back in the 2000s, I remember reading they got over 50% returns when the stock market was down. Just really great stuff coming out of these folks. And I'll put the link to further reading for you in the video description itself, so you can go off and get nerdy with all the numbers. But anyway, CTA employs a combination of price trend investing, carry strategies, and unique risk-off models that can aggressively buy bonds during equity market downturns. So it does do trading in rates, but not I shouldn't say bonds directly. Its exposure is the most focused of the bunch of different managed futures funds that you can choose from. And it concentrates strictly on commodities and rates. And I'll put a link to it so you can see exactly which commodity baskets and rates it does focus on. But it has an emphasis on North America simply because that market is very highly liquid, very prone to trends, and very understandable to people who actually trade and sell stuff in North America. It really doesn't make sense for, I'd say, a merchant in North America to be doing a lot of rates and commodity trading from the perspective of Saudi Arabia, for example. You're going to be better trading what you know than trading what you don't. Anyway, CTA also comes with the lowest expense ratio of the trio of popular managed futures funds, and its expense ratio is just 0.75%, which is outstanding for these strategies. So which one do I like best? Well, I already showed my cards there. While DBMF and KMLM are solid contenders, my preferred choice for the Miller Momentum strategy is the CTA ETF. And here's why. First, lower fees. At 0.75%, it's the most cost-effective option, which minimizes the drag on long-term returns. Second, and more importantly, it offers cleaner diversification. By explicitly excluding equity and currency futures, CTA focuses purely on commodities and rates. This avoids doubling up on the risks already present in most portfolios, including mine, because I'm already making currency bets with my international stocks. They are not currency hedged. I already have gold, which in itself is a hedge against currency debasement. I've already got stocks with my momentum strategy, so I don't need to have another fund that's dealing with, S&P 500 futures or anything like that. In my opinion, this structural exclusion makes CTA a much purer hedge against traditional market risks compared to its peers. And I think that Altice Partners' track record for their algorithms over the past 20 years really demonstrates this. Although you can never know anything for certain, so it'll be fascinating to see how these three popular managed futures strategies perform in the years to come. But what about idiosyncratic risk? What if I just picked a weird fund manager with the CTA ETF? I'm not too worried about it. So right here, I've got a chart pulled up for year to date for 2025. CTA has been doing right in the middle of these three strategies, KMLM, DBMF, and CTA. That's exactly what I'd expect it to do this year, just given trends in livestock and other commodities. So first of all, what you'll notice is DBMF is mirroring to a large extent the ups and downs in the equity market this year. So you can see a big, massive sink back in April around Liberation Day, and then a recovery going up with the stock market. CTA is mirroring in large part the trends that KMLM is doing, and that's exactly what I'd expect it to do. Because again, there's only so many ways that you can follow a trend or do mean reversion algorithms and other stuff, and a lot of the trading techniques in the CTA world are very well known. The reason why KMLM is going down and CTA is not is very easily explained by the fact that KMLM does currency trading, whereas CTA does not, and that's really the only difference between the two as near as I can tell. And other than that, they tend to behave very similarly, which again is exactly what I would expect because they're There's only so many ways you can follow a trend, and the real distinction of CTA ETF is that it excludes currency futures. So I'm not worried about it going off the rails, because otherwise it's going to do pretty much what KMLM does, or most of the other top 20 largest CTAs. And you can really see the downtrend in the US dollar, the relative strength of the US dollar, rather, and that explains why KMLM is going down this year. I'll pull that up next on the screen. Ta-da! Like I told you, US dollar is going down, and that's why the general trend of KMLM is going down as well, because it does a lot of currency trading in its algorithm. Also, as an aside, this is why international stocks, well, part of why international stocks are really popping off this year, because the relative strength of the US dollar is trending downward, and most international indices are unhedged, which means if the dollar goes down, international stocks don't have to do anything. They're just going to become more valuable because of foreign currency exchange rates. That's all there is to it. But again, this is all just my take. Each of these ETFs has its own merits depending on your portfolio's needs. Which one do you prefer and why, if you use one of these strategies? Let me know down in the comments. If you found this comparison helpful, smash that like button and subscribe for more in-depth portfolio strategies. And thanks for watching, and I'll catch you in the next video. Let's keep rolling with Miller Momentum.